Hello everyone and welcome back to the sessions on strategic financial management. Friends, if you are a CA final student and planning to appear your exam in this coming term, and if you are facing one problem, this problem, how do I revise the topic derivatives in minimal time, then I would say you are at the right place and watching the right video. So friends, this is an obvious question in the minds of students. Derivatives being a big huge topic in the paper of strategic financial management, how to revise it in minimum possible time, and there is a way, definitely a systematic way. So friends, what I will do is, I have given link of a video which I have taken on basic concepts of derivatives. So the link will be shared at the bottom of the video. If you are not clear with the basic concepts of derivatives, I would recommend you to watch that video first before you start with the revisionary video, and if you are done with those basic things, you can continue watching this video. Now, whether you are clear with the basics or not, for that how would you assess? There is a simple assessment. I will provide a checklist of questions over here, and if the response to all those questions are positive, as in you know those things very well, then you don't have to go back to the basics and you can just go ahead with the revisionary part. However, it is only after your response to those questions you will be able to decide whether you are good to go with revisions or you definitely require basic concepts to be clarified first. So what I will do is, I will just put forward that checklist right now in front of you. So please refer to this checklist, which begins with the first question as, what is meant by derivatives? What are functions of a derivative? What are the types of derivatives? Who are the various participants in derivative? What are forwards and futures contracts? How do you differentiate between forwards and futures? What are bullish and bearish sentiments? What are long and short positions? What is short selling? How can you speculate through forwards and futures? How does margin mechanism work in futures contract? So friends, I told you, if the response to this checklist that comes from your side is a positive response, you believe that you are through with all these questions, you know the answers for all these questions, you are good to go with the revision part. If not, you should go ahead with the basic parts of derivatives, the link for which I have already shared in this video. I mean, below this video, the link has already been shared. Now, only if you need the basic parts you can go with that link. Otherwise, if you are good to go with the revisions, please continue watching this video itself. So when we talk about the revisions of derivatives, the first thing that we have to hit is futures. So you know one thing, derivative market, also known as FNO market, because two primary instruments that are dealt with in the derivative market are futures and options. That is why derivative market is also known as FNO market. So we will first deal with futures. In terms of futures, you should be clear with one thing again, why someone would enter into a futures contract. The objective for entering into a futures contract could be any of the three possible objectives. Number one could be arbitrage. Number two, it could be a speculative objective. Number three, it could be hedging. So when it comes to this particular objective, we are going to talk about arbitrage, speculation and hedging one by one. So let us begin with the first part, that is arbitrage. Now friends, you have to understand one thing, what exactly is the meaning of this term arbitrage. Arbitrage in the simplest word can be defined as, it is an act of making riskless profit. So it is basically making riskless profit. You are aiming at making profits without taking any risk. That is typically difference between arbitrage and speculation. Speculation involves risk taking for earning profit, whereas arbitrage on the other side is making riskless profit. So right now we are talking about arbitrage. So how does this happen? How does arbitrage work? It is simply going to be effected when you buy something in one market and sell the same in the other market. So here, buying something from one market and selling the same in the other market is the basic tendency for dealing in arbitrage. Now, just let me give you one simplest example for you to be clear with this. Suppose there is a product available in one market at a price of rupees 100. The same product is available in other market at price of 110. So what you would do is, you make a defined contract, you make a purchase arrangement at the first market, buy it at 100. Parallelly, you enter into a firm commitment with a counterparty so that you can sell the same product in that other market at rupees 110. So at 100 you are buying, at 110 you are selling. That difference is your arbitrage gain. Here in the stock market and derivative market, how would arbitrage happen using futures contract is our primary objective of this video. So please try to understand one thing. You will be always having an underlying asset as a stock. For example, there is a company X Limited and its share current market price is rupees 400. I repeat, the current market price of X Limited's equity share is rupees 400. Now, the risk-free interest rate that is prevailing in the market is suppose 10% per annum, and you are talking about 1 year futures contract. So what you will do is, from the spot price of the share, I repeat, from the spot price of the share, which is rupees 400 in my example, you will derive a future price, and to do that you will compute something called as fair futures price, and this is basically the future value of this spot price. To arrive at that future value, you just have to apply cost of carry model. In other words, if you are purchasing this share at rupees 400 today, use your simple common sense. If you are purchasing this share for rupees 400 today and you have arranged money for buying this share today as from a borrowing at 10% per annum, I repeat once again, you have purchased this share at rupees 400 today and the money has been arranged by way of borrowings at 10% per annum. After 1 year, your obligation to pay back will be 400 of initial borrowing and plus 10% interest. So what will happen is, your maturity value of that borrowing will become 440, and so when you are adding that interest element to the spot price of the share, the fair futures price what you derive is rupees 440. So rupees 440 will be fair futures price. When I say fair futures price, means after 1 year the worth of the share should be 440. I am not saying it will be 440, I am saying it should be 440. Now what you should do is, go to the futures market and look into the contract of 1 year's future for the same stock. That means 1 year contract of futures on stock of X Limited. Look at what is the actual price quoted. If the actual future price is matching with the fair futures price, you will not have any arbitrage opportunity. However, if there is a mismatch between the actual futures price and the fair futures price, definitely you can have an arbitrage. And how to avail the advantage from that arbitrage opportunity, that is what we are going to learn through a calculative example. So friends, when I am showing up that calculative example, please take note of that example in a systematic manner, and throughout the video I will be instructing you to note down certain things. However, because of restriction of timing, I will not be able to give you extended time to write down. So if you want to write down any part of the notes, you can simply pause the video, note it down, and then you can move ahead. So let us begin with that calculative example to completely understand the basics of arbitrage through futures contract. And once you are done with that, you are simply going to go into the details of arbitrage using futures. Let us read what is given in question number 1. Price of share of X Limited in spot market is rupees 400. Rate of interest prevailing in money market is 10% per annum compounded annually. Determine the fair futures price and indicate if there is any arbitrage opportunity. If yes, determine the arbitrage strategy and explain the process of arbitrage under the following situations. Number 1, actual futures price for 1 year is rupees 460, and number 2, actual futures price for 1 year is rupees 420. To begin your answer, you should first find the fair futures price, which I have already explained to you. It will be the current market price plus the interest element. So in this case, it will be 400 plus 10%, that is 440. And now compare the fair futures price with the actual futures price quoted in the market. So case 1, actual futures price is given as rupees 460. So when you compare, you definitely find that the actual price and fair price, they are different, and therefore arbitrage opportunity exists because AFP, that is actual futures price, is not equal to FFP. So AFP is found to be greater than FFP. Therefore, in the futures market, the share is considered to be overpriced, and it will be better to sell the share in the futures market. In order to take the counter position, the share should be purchased in the spot market. Therefore, the arbitrage strategy will be buy spot and sell futures. So friends, quickly take note of this whole thing and then I take you ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write down the arbitrage process. So arbitrage process will be step by step structuring of the entire strategy. So first step will be to borrow rupees 400 for 1 year at risk free rate of 10% per annum. Understand one thing very well. Your strategy was to buy the share in the spot market. Obviously, to buy the share you will need money, and this money you have to arrange by making sufficient borrowings, and this borrowings will be raised from money market for 1 year period at the given interest rate of 10% per annum. Then second step will be to buy the share in the spot market utilizing the same amount that you have arranged through borrowings, that is buy the share at the current market price of rupees 400. Step 3 will be to enter into futures contract with short position, that is to sell at a contracted price of 460. Don't ever forget, your strategy started from this point, right? That is to sell in the futures market. Selling in the futures market means entering into a futures contract with a short position. Now, once you have performed these 3 steps at the beginning of the year, you have to now simply wait for 1 year. All the positions that you have opened up, you will have to gradually close each of these one by one. You have to settle each of these contracts one by one. So what happens after 1 year is honor the futures contract and sell the share at rupees 460. My friends, in the previous session, I have explained you that if you enter into a futures contract by a short position, no matter what happens, you will be able to sell the share at the contracted price. We have learned this as a very important example in the last part of the first lecture. Then, what do you do? Step 5, repay the money market borrowings with interest. So what you have borrowed was 400, with interest what you have to repay is 440, and what you find, step 4 was giving you an inflow, step 5 is an outflow. Difference between these two will be your arbitrage gain. So arbitrage gain will be inflow as per step 4 minus outflow as per step 5. 460 minus 440, that gives you an arbitrage gain of rupees 20. Alright friends, moving ahead to the next scenario, the next case, when actual futures price is given as rupees 420. So what we find in this case, again an arbitrage opportunity exists because actual futures price is still not matching with the fair futures price. This time we find that AFP is less than FFP. Because actual price is less than the fair futures price, we identify that the stock is underpriced in the futures market. Something which is underpriced, obviously you would want to buy. Therefore, it is better to buy the stock in the futures market. Because you have agreed to buy the share in the futures market, in the spot market you have to take a counter position. So, to take that counter position, you should sell the shares in the spot market. So, arbitrage strategy will be sell spot and buy futures. So, we continue writing the solution ahead and we begin with the arbitrage process. The first step will be short sell the stock in the spot market at rupees 400, which means borrowing the stock for 1 year and selling the same borrowed stock in the spot market at rupees 400. This is what we call as short selling. Now you have 400 rupees in hand. What you will do with this money? Simply in step 2, invest rupees 400 in money market at risk free interest rate of 10%. So what you get at the end of the year in hand as return of this investment will be 440 as a payback of this investment made today. Now what happens? Simultaneously perform one more thing, that is enter into futures contract with a long position, that is to buy at a contracted price of rupees 420. So understand one thing, here we have decided to buy in futures market. Buying in futures market means to enter into a futures contract with a long position. Friends, before I take you ahead, quickly note down this much. Alright friends, you would have finished writing this. The process ahead would require a waiting period of 1 year. So what happens after 1 year? You realize your investment from money market, which will have a maturity value of rupees 440, and then what you do is honor your futures contract and buy the share at rupees 420. This is called buy to cover, which is to exit the position of short selling. The purchased share at rupees 420 will be given back to the stock lender, that is from the party from whom you have borrowed the stock at the beginning of the year. And the last step will be the arbitrage gain calculation, which will be inflow as per step 4 minus outflow as per step 5. 440 minus 420 will give you rupees 20 as arbitrage gain. So friends, note down this also, and that will be end of the solution. Alright friends, let us move ahead and talk about the next concept, that is concept number 7, continuous compounding. This is all about determining the present value out of a given future value or determining a future value from the current spot price of the share. The way we have dealt with in earlier situation using compounding basis as annual compounding. So here we are changing the base of compounding, that's all. We are introducing the concept of continuous compounding, where to determine the future price you will apply the future value factor to the present value. So let me explain through this given equation. P stands for the present value, e raised to RT is the future value factor. So the way in the earlier example what you did, you took the present market price of the share as 400 and then you have applied 10% interest. Your factor for that 1 year became 1.1. 400 into 1.1 became 440. Now we are applying continuous compounding. The factor will not be based on annual compounding, it will be based on continuous compounding. So that is the only change. So what you do is, if you have to find the future value from the present value, you will simply take P into e raised to RT. On the other side, if you want to determine the present value out of a given future value, what you would do is f divided by e raised to rt to obtain the present value, or alternatively you may take p equals to f into e raised to minus rt. Now friends, I am sure these basic things you know very well. Let me take you ahead with concept number 8, that is arbitrage using futures. Now friends, based on the example that we have just covered up through question number 1, if you can summarize and recall what did you learn out of that. In any question of arbitrage using futures, you will be given some typical type of information. One will be definitely the spot price of the share, another information will be the risk-free interest rate, and maybe some other supportive information for determining fair futures price. When I say fair futures price, I told you the futures price that you determine using the spot price information and interest and other information which is available to you. That futures price you are determining. It is not the futures price which is quoted in the futures market or quoted in FNO market. So because it is your calculation, you will call it as fair futures price, which indicates that should be the price of the stock in the futures market. What is the actual price? It will be something different. So then begins the comparison between the actual futures price and the fair futures price. If the actual futures price is less or more than the fair futures price, you get an arbitrage opportunity. And how do you build up an arbitrage strategy? I have explained you already. If the actual futures price is less than the fair futures price, you would say that in the futures market the stock is underpriced, so it is good to purchase the stock in the futures market. Means in the futures market you should take a long position, and to take a counter position in the spot market you should definitely take a short position in the spot market, which would indicate short selling. So it would be sell spot and buy futures. However, when you compare the actual futures price and the fair futures price, and if you find that actual futures price is greater than the fair futures price, you would find that the stock is overpriced in the futures market. So in the futures market you should take a short position, and the counter position should be taken in the spot market, that is a long position. When I say long position, means you should buy the stock. So in that case your arbitrage strategy will be buy spot, sell futures. So friends, there could be only 3 possible scenarios. One could be that actual futures price and fair futures price are same and there is no arbitrage opportunity. Second possibility could be AFP, that is actual futures price is less than the fair futures price, where you would say it is underpriced in the futures market, or if it is more than the fair futures price, you would say it is overpriced in the futures market. As a result, if there is any arbitrage opportunity because of mismatch between actual futures price and fair futures price, there will be only 2 possible arbitrage strategies. One could be buy spot, sell futures, and one would be sell spot, buy futures. In such case, when to apply which strategy we have discussed already. So what else we are going to learn in this category, arbitrage through futures? We are going to learn a lot, because what we have learned earlier through question number 1 was a simple scenario. Now there may be little complication in this. First of all, you have to start applying the concept of continuous compounding in place of annual compounding. So there will be no annual compounding in reality. It will always be, the fair futures price will always be computed based on continuous compounding. However, in examination the question could ask you to use monthly compounding or quarterly compounding or annual compounding or continuous compounding. It will completely depend upon the information and language used in the question, where you have to be very smart in correctly interpreting that language. Now friends, what we are going to do is, we are going to discuss 5 different scenarios, 5 different situations of deriving or determining fair futures price. Once you get fair futures price, you are simply going to compare the actual futures price with the fair futures price and you will establish an arbitrage strategy. The process and everything thereafter is common, simple. What is the challenge over here is in different situations how to determine the fair futures price, and this is the part which gets little tricky, and I want you to completely pay attention to this. So we have in total 5 different situations. The first 3 situations are situations of security, that means it's a futures contract of any stock or any security. The later 2 situations are commodity futures, that is arbitrage through commodity futures, where it would be commodity which will be the underlying asset. So once you are clear with the first 3 situations, on your own you will understand the later 2 situations of commodity futures. I will just have to provide a little bit of guidance, that's all. But the first 3 situations primarily should be focused on and should be understood very well. So let us begin our discussion one by one with all those 3 situations, the first 3 situations I mean. The first situation would be securities that do not provide any income. So it's a security that you are buying and it is not providing any income. That means this could be simplest example of non-dividend paying shares. So these non-dividend paying shares could be classified as securities that do not provide any income. For such securities, computing fair futures price would be simplest. What you would do is FFP, fair futures price, equals to S0. S0 is the current spot price multiplied by e raised to RT. E raised to RT will be the future value factor using continuous compounding. So FFP equals to S0 into e raised to RT. That's all. Simply compute the future value using continuous compounding. Second situation is the situation where you are going to receive a definite amount of income at a definite date in future. This could be a scenario where the company has already declared some dividend on any stock and you are buying that stock. So today you are buying that stock. Suppose after a month's time you are going to receive dividend on that, and at the date when you have purchased the stock come dividend, you already know that you have paid for the stock and you have also paid for that dividend. Assume that today you have paid rupees 400 to purchase that stock. After 1 month you will be getting dividend on that stock amounting to rupees 30. So logically from your pocket you are spending 400 today, and after a month's time you will get back 30. So what is your net investment if you consider? So anyone would say 400 minus 30, correct? But here you have to be taking little caution. You cannot take 400 minus 30 directly. 30 is the amount of dividend that you will receive after 1 month. So what you should do today is from 400, do not directly subtract 30, subtract the present value of that 30. So it will be S0 minus I0. I0 is the present value of that income that you are going to receive. So S0 minus I, S0 is the current spot price minus I0, I0 is the present value of the dividend receivable, S0 minus I0 into e raised to RT will be what you have to do. So within brackets it will be S0 minus I0, outside the bracket multiply e raised to RT. You will get to know what would be the fair futures price. But the second situation depends on the fact that you are going to receive a definite amount of dividend or definite amount of income at a definite date in future. Now coming to the next aspect, that is the third situation. This third situation would be a situation where you will not get a definite amount of cash flow at a definite date in future. It is in fact a situation where throughout the holding period you will be earning some dividend yield. So let me explain it again by giving an example. Earlier example I told you that instead of your spot price taken 400, you have taken 400 minus present value of 30. So it was a definite cash flow. You adjusted with the cash outflow the present value of the income receivable. Here it is not about inflow and outflow. Assume it this way: when you have purchased the stock, you have borrowed money from money market at suppose 10% per annum, and when you are holding this security is providing you an yield of 6% per annum. So you have purchased the stock by borrowing at 10% per annum. Throughout the period of holding, you will incur cost of 10% per annum, and in that same period you will also earn dividend yield at the rate of 6% per annum. So logically, throughout the period of holding, you are spending 10% per annum and you are earning 6% per annum. So what is your net rate of interest? It will be obviously 10% minus 6%, that is 4%. So what we do this time is, we don't make any adjustment to the spot price, which is S0, that remains undisturbed. When on a usual basis, what you would do, S0 into e raised to RT, here it will be S0 into e raised to R minus Y. R is the risk free rate and Y is the yield rate that you are earning. You are going to net off the rates. So R minus Y within brackets multiplied by T, that will be the exponent value of E. In other words, it will be e raised to within brackets R minus Y multiplied by T, and that would be finally multiplied to the spot price to arrive at fair futures price. Once you get fair futures price, you know what you have to do ahead, and thereafter things are simple. So friends, what I would do is, I will take you through these first three situations at the first instance. Then we will introduce the concept of commodity futures, the later two situations, and for your better understanding, for each situation I have included a calculative example, and that would be helpful. And as I told you, you should write down as and when you find something needful. So let us begin with all these situations one by one. So let us deal with the first situation over here, that is securities providing no income. Now friends, this could be a case where the company in which you are investing does not distribute any dividend, or say you are trying to deal with bonds which are zero coupon bonds or deep discount bonds where there is no income element involved. In such case, determining the fair future price is a very simple task. We have just learned the concept of future value using continuous compounding. S0 indicates the spot price, that is the present value, multiplied by e raised to RT. E raised to RT is the future value factor or the interest factor. When this factor applied on the present value, what you get is the fair futures price. So we can write the definition of these variables. F stands for fair futures price, S0 is the current market price, R is the rate of interest, and T is the time remaining for maturity. And you should not forget that T is always to be expressed in number of years. My friends, what you find on screen is again given in your textbooks, so there is no need to write up this. Let us practice a question linked with this situation. So we have question number 5. Let us read this question. X Limited, a company that historically has not paid any dividend and has no plans to do so in the future, is currently being quoted at the Bombay Stock Exchange at rupees 60. You wish to enter into a futures contract on this stock maturing in 3 months' time. If the risk-free rate of return is 8% per annum continuously compounded, what do you expect the futures price to be? If the futures contract were priced at rupees 64, what action would you take? In case it is priced at rupees 60, will your decision change? And the table value of e raised to 0.02 is given to you in the question as 1.0202. So friends, we find one thing very clearly over here, that the current market price of the stock is given. We have been given the maturity value of the futures contract, that is 3 months. and we have also been given the rate of interest on continuous compounding basis. We have been also informed the actual futures price. So to formulate the arbitrage strategy, what we need to do is we need to determine the fair futures price. Determining fair futures price would simply require this first situation what we have learned, because this company does not pay any dividend at all. So this is classified as securities providing no income. So let us understand how to present the solution. So when you have to write up the solution, first you calculate the fair futures price and you write the equation for fair futures price as a spot price into e raised to RT, and explain the variables when you are writing up the solution. Once you have defined all these variables, you may substitute the values. Alright friends, let us move ahead. FFP, it is 60 into e raised to 0.08 into 3 by 12, that is e raised to RT will be e raised to 0.08 into 3 by 12. So now it is 60 into e raised to 0.02. Simply 8% into 3 by 12 will make it just 2% effectively. So it is e raised to 0.02, and e raised to 0.02 value is given in the question already. So 60 into 1.0202, and what you get is FFP as 61.212. So you may write up fair futures price as 61.212. Alright, moving ahead, this is the fair futures price what we have computed, and in the question they have informed the actual futures price, and not one but two different situations given to you. So the first thing what is informed, if AFP equals to rupees 64, it is considered that the share is overpriced in the futures market. You will compare 64 with 61.212. So 61.212 is less and 64 is more. So the actual price being more, we say that the stock is overpriced in the futures market, and for making the arbitrage gain, the investor should adopt the strategy as, because it is overpriced in the futures market you are going to sell it, and so in the spot market you will have to take a counter position, that is buy in the spot market and sell in the futures market. So your arbitrage strategy will be buy spot and sell futures. The next thing given to you is what will happen if actual futures price is 60. So if AFP equals to rupees 60, it is considered that the share is underpriced in the futures market. For making arbitrage gain, the investor should adopt the strategy as sell spot and buy futures. Being underpriced in futures market, you should tend to buy in futures market, and taking counter position in spot market, you should plan to sell spot. So your arbitrage strategy in the later part will be sell spot and buy futures. Alright friends, let us move ahead to the next situation. Situation 2, that talks about securities providing known cash income. So when you are dealing with situation 2, that is securities providing known cash income, you will take the equation as F equals to S0 minus I0 into e raised to RT. So basically what we have learned earlier, it was simply S0 into e raised to RT. Additional thing what you are doing over here is the present value of dividend you are subtracting from the current market price. So define all the variables. F is the fair futures price, S0 is the current market price, I0 is the present value of dividend receivable, R is the rate of interest, and T is the time remaining for maturity. Let us see application of this through question number 6. So question number 6 is talking about shares of Z Limited is quoted in the market at rupees 40. That means this is S0. A 6-month futures contract on 100 shares of Z Limited can be bought. The risk-free rate of interest is 12% per annum continuously compounded. Z Limited is certain to pay a dividend of rupees 2.5 per share 3 months from now. What would be the value of the futures contract? If the futures contract is priced at rupees 4,100, what action would follow? If it is priced at rupees 3,800, what would you do? and they have given table value of e raised to minus 0.03 and e raised to 0.06. So friends, let us first understand the whole scenario. We have been informed that the company is certain to pay a dividend after 3 months. That means this is purely a situation 2 question where a definite amount of dividend will be received after a definite point of time. Observe one thing, that the futures price is given as 4,100 and the current market price of the share is given as 40. Obviously, something whose price is 40 cannot have a futures price of 4,100. This 4,100 is because of this 100 shares. That means the lot size being 100 shares in the contract, the price is given to you not for a single share but for 100 shares. As a result, you are not supposed to alter the actual prices quoted. So the fair prices should be brought in line with the actual prices. So fair price will also be determined for the lot of 100 shares. So let us see how to put up the calculations in the solution. First of all, we write up the equation f equals to S0 minus I0 into e raised to RT and define all the variables. F is the fair futures price, S0 is the current market price, I0 is the present value of dividend receivable, R is the rate of interest and T is the time remaining for maturity. Alright, let us move ahead and substitute all these values. We first find the present value of dividend. So I0 will be dividend amount multiplied by e raised to minus RT, and now this will be, because we have to make calculations for 100 shares, per share dividend is 2.5, we have taken the total dividend as 2.5 multiplied by 100. Now one very important thing, the time involved over here should not be the maturity value of the futures contract. This time is the time for which the dividend income is expected to be received. That means here this will be a 3 months time by end of which you are going to receive dividend. So be very sure when you are dealing with a case like this, dividend into e raised to minus RT, time period involved over here should not be the time remaining for the maturity of futures contract, it should be the time for which the dividend is expected to be received. So when you apply this, it will be e raised to minus 0.03 and whose table value is already given to you in the question. You simply multiply that given value, that is 0.97045 into the dividend amount to arrive at the present value of dividend, which is 242.6125. So when you get the dividend amount converted to its present value, that is I0 has been determined, you are ready to arrive at the fair futures price using this equation, that is S0 minus I0 into e raised to RT. The time taken over here, the time factor considered in this equation will be obviously the remaining time for maturity of the futures contract, that is 6 months in the given case. So 4,000. Now why we have taken 4,000? Per share price was 40, but the lot size of the futures contract is 100 shares, and more importantly the actual futures price is not given for individual share, it is given for the entire lot size of 100 shares. So S0 will be for 100 shares, that is 4,000. This dividend is already for 100 shares, that is 242.6125, what we have just computed over here, multiplied by e raised to 0.06. When you take the values given within the bracket, it gets the net amount of 3757.3875, and e raised to 0.06 is given to you in the question as 1.06184. Finally, the fair futures price comes to 3989.75, which we have written down over here. So friends, quickly take note of this and then I take you ahead. Alright, moving ahead. Now this fair future price will be compared with the actual futures price given in the question to formulate the arbitrage strategy. Now friends, I don't have to explain you that again and again as in how to do that, you know it very well. So let us see. You have been given two different prices. One of the actual future price is 4,100, against that fair futures price of 3989, when you compare the actual price, it is definitely more and it is considered overpriced in the futures market. So in the futures you should sell, so in the spot you should buy. So your strategy formulated will be buy spot and sell futures. On the other side, the other price given to you is 3800. When it is 3800 compared with 3989, which is a fair futures price, this 3800 is low. That means this is underpriced in the futures market. So in the futures market you should buy, and counter position in the spot market should be to sell. So your strategy formulated is sell spot and buy futures. Alright friends, let us move ahead and deal with the third situation. Situation 3 talks about securities providing known yield. So for situation 3, where securities are providing a known yield, F equals to S0 into e raised to r minus y into t. So as I have just explained, R stands for the rate of interest prevailing in the money market and Y stands for the yield. So in the example that I have just given you, if you have borrowed from money market at 12% and the security is providing you the yield of 8%, so you borrowed at 12% and you are earning 8%, so net interest cost that you incur will be just 4%, 12 minus 8, that is 4%. That's all what you have to do differently over here. So let us write up the variables. F is the fair futures price, S0 is the current market price, R is the rate of interest prevailing in money market, Y is the yield rate on security, and T is obviously the time remaining for maturity of the futures contract. So to deal with this situation, let us take up a relevant question, that is question number 7. Let us read what is given over here. If NJ Limited provides a dividend yield of 4% per annum, the current value of stock is rupees 500 and the continuously compounded risk-free rate of interest is 8% per annum, what would be the value of a 3-month futures contract? If the futures price is rupees 510, what action would follow? Will the position change if the price is rupees 490? Table value of e raised to 0.01 is given to you as 1.01005. Let us analyze what is given as information in the question. This is the rate of interest prevailing in the money market, that is R, and this is the yield rate on the security, that is Y. So R minus Y, that is 8% minus 4%, will give you again the net cost of 4%, which you will apply as e raised to r minus y into t, and this is the spot price given to you, that is S0, and time remaining for maturity is 3 months, and then the actual futures prices are given, two different prices are given, that is 510 and 490. So let us see how to present the solution. So we first write up the equation and define all the variables. I have already explained you this equation and all these variables, so just quickly take note of this and then we move ahead. Friends, writing such equation and defining all the variables as part of solution is compulsory, don't skip that. Alright, let us move ahead. Once you have written the equation and defined all the variables, time for us to substitute all the given values in these equations. So in the equation, what you simply do is S0 is 500, e raised to R is 8%, R minus Y is 4%, and time remaining for maturity is 3 months, but we have to write it in terms of number of years, so written as 3 by 12. So when you take, this will be 0.04 net into 3 by 12 will finally give you e raised to 0.01, whose value is given to you in the question as 1.01005 multiplied to 500 gives you 505.025. So we can declare fair futures price is 505.025. So please take note of these calculations and then we formulate the arbitrage strategy. Alright friends, let us move ahead. We have been given two different actual prices, that is the prices given for the futures contract. So the first price given is 510 if the fair futures price is 505 and the actual futures price is found to be 510, obviously it is considered overpriced in the futures market. So in the futures market you would sell, and taking counter position in the spot market you would buy. So your arbitrage strategy will be buy spot and sell futures. On the other side, if the price quoted is 490, in the futures market we would say that the stock is underpriced, so we should buy in the futures. Taking counter position, we should sell in the spot market. So arbitrage strategy will be sell spot and buy futures. So in situation 4, we are talking about carry type commodities. Pay attention to this line. When carrying cost is given as a certain future cash flow. So in that case, what you are going to do, I have just explained to you, F equals to S0 plus C0 into e raised to RT. You would define all these variables, what I have already explained to you. S0 is the current market price and C0 is the present value of carrying cost. R is the rate of interest and T is the time remaining for maturity. So friends, this you don't have to write, it is given in your textbook already. Let us move ahead and understand the application of this concept. We take up question number 8. What is given over here? Consider a 6-month gold futures contract of 100 grams. If the spot price is rupees 600 per gram and that it cost rupees 3 per gram for a 6 monthly period to store gold, and that the cost is incurred at the end of 2 months. If the risk-free rate of interest is 12% per annum continuously compounded, compute the futures price. If the futures were available at rupees 660, what action would follow? Would the position change if the futures were available at rupees 620? Table value of e raised to minus 0.02 and e raised to 0.06, both are given to you. So let us first analyze the question. What is given over here? The lot size is 100 grams of the gold and this is the spot price S0. It would cost rupees 3 to carry the gold and this is payable after 2 months. So friends, we cannot directly add 3 to 600. You should understand that 3 is payable not today but after 2 months. So this 3 will be converted to its present value over a 2 months period, and the present value of 3 will be added to the spot price. So it will be S0 plus C0. So this present value added to spot price becomes the base cost, that is S0 plus C0, and then multiplied by e raised to RT. That time rate of interest is given as 12%, and then the T that you consider for computing FFP, that is fair future price, will be a 6-month period. You should understand, for computing the present value of carrying cost you should apply 2 months, and for computing fair futures price you should apply 6 months time, and that is why table value of e raised to minus 0.02 as well as 0.06, that is e raised to 0.06, both are separately given to you. So let us understand how to present the solution. First of all, you would write the equation F equals to S0 plus C0 into e raised to RT. Define all the variables as I have already explained to you. And friends, again and again I am telling you one thing, that you should not avoid writing all this as part of solution. It is mandate for you to write up this. Alright friends, let us move ahead. What we find next is the substitution of all these values in the equation. So we will first find the value of C0, that is cost multiplied by e raised to minus RT. Rate of interest will be 12%, but time involved over here, as I have told you, should be 2 months. So it will be e raised to negative 0.02, value of which is given to you already, that multiplied to 3. The present value of carrying cost comes to 2.94. Substitute this 2.94 in the equation of fair futures price, and what we get is 600 plus 2.94 into e raised to RT. This time T will be the factor of 6 months. So 602.94 into e raised to 0.06 e raised to 0.06 has been given as 1.06184. The final value what you get is 640.23. So your calculation of futures price, that is fair futures price, is ready. Please take note of this and then we move ahead. Alright friends, let us move ahead. After making calculation of fair futures price, you would compare the futures price, that is actual futures price which is given to you. The first price given to you is rupees 660, which is greater than the fair futures price that we have computed, and so we find that the gold is overpriced in the futures market, and so in the futures market it will be better to sell. So in the spot market you should preferably buy. So the strategy will be buy spot and sell futures. If the contract price is 620, which is the other price given to you, you should take the inverse strategy, that is sell spot and buy futures. Alright friends, let us move ahead. What we do now is deal with a very similar type of situation, that is still carry type commodities, but a little difference over here, that is carrying cost is given in terms of percentage. Even this I have explained you very well some time back. So the equation over here will be F equals to S0 into e raised to r plus c into t, and you may just define all the variables used over here, and all this is given to you in the textbook, so you need not write up this. When we have to solve a question relating to this, obviously we will write up all this stuff. So let us deal with question number 9. Consider a 6-month gold futures contract of 100 grams if spot price is rupees 600 per gram and it costs 6% per annum continuously compounded for a 6-monthly period to store gold. You see, this time carrying cost is given as 6% and 6% is given again as 6% per annum. So we have 6% per annum as carrying cost and risk free rate of interest is given as 12%. Continuous compounded. Compute the value of futures price, and then 670 and 640 are the two different prices given to you, and table value of e raised to 0.09 given to you. So let us see how to solve this question. We have just learnt the application of fifth situation, that is F equals to S0 into e raised to r plus c into t. Let us apply the same. So this is the equation, and here you have to define all these variables. F stands for fair futures price, S0 is the current market price, R is the rate of interest based on continuous compounding, C is carrying cost given in percentage, and T is the time remaining for maturity. Alright friends, let us move ahead. Once we have written this equation and defined all the variables, let us substitute all the values in the equation, and what we get is 600 into e raised to 0.12 plus 0.06, that is e raised to r plus c, and then r plus c will be multiplied to t, that is 6 by 12. So what we get finally is, this will be 12 plus 6, 18%, into 6 by 12 will become 9% effectively. So this whole thing will become e raised to 0.09, and we get 600 into e raised to 0.09, and e raised to 0.09 value is given to you already in the question as 1.09417. What you get as a fair futures price is 656.50. So once we have got this, then we can formulate the arbitrage strategy. Alright friends, let us move ahead and deal with the arbitrage strategy formulation. So you have been given the first price as 670. The moment you find that the price is 670 quoted in the futures market, it is obviously indication of overpricing, and so it is better to sell in the futures market, and contrary, you make a long position in the spot market, that is buy in the spot market. Your strategy will be buy spot and sell futures, and if the price is given as 640, you would just make a reverse strategy, that is sell spot and buy futures.